Good afternoon, everyone, and welcome back to our afternoon keynote panel of the Capital Markets and Investment Day and Biotech Leaders Agenda of the LSX World Congress 2021. Rounding off our discussions today, delighted to be having a truly sort of international panel. We're across multiple different time zones discussing the investment landscape pandemic era, as it were, both in 2020 and onwards through 2021. Please do keep on using the chat function and the Q&A boxes to the right-hand side of the video here, and we'll get to as many of the questions as we can and put them to our panel. Yeah, keep the conversation going. So without further ado, delighted to hand you over to Bill Hicks with Mintz, our moderator for today's discussion. Bill, the stage is yours.
Thanks, Josh. My name is Bill Hicks. I'm the co-chair of the Securities and Capital Markets practice at Mintz in Boston. We represent private companies in biotech, and we take them public, and then we represent public companies as well as underwriters and investors. First, it'd be great if the panel, each person could introduce themselves. Regina, do you want to?
Sure, very happy to. So Regina Audits, I'm a managing partner at Wellington Partners, a German-based life science fund investing mainly in Europe and thereof mainly in the German-speaking area in anything that really can change medical practice. And we've been doing so for quite a while, for over 2 decades. And yeah, I've seen a couple of cycles up and down and have hardly seen a busy year as 2020. And if you look back a year from now to the beginning of 2020, this was not quite how we assumed this year would go. So very happy to discuss this further.
Wouter.
Thank you, Bill. So my name is Valtryeaustra. I'm one of the general partners for the Forbion Growth Fund, which is the latest stage fund of the Forbion platform. So on the Forbion platform, we invest from very early stage company building to the mid stage with Forbion Ventures, and then late stage with Forbion Growth that focuses on phase 2 and phase 3 financing rounds. And we raised about $1 billion this year, which brings us to 1.8 billion under management. And me personally, I have a background from the investment banking side. Thank you.
Stephanie.
Hi, Bill. Stephanie Sirota. I'm a partner and chief business officer at RTW Investments. We're headquartered in New York. We're a $6 billion entrepreneurial investment firm. Our mission really is to identify what we think are going to be really important, transformative assets, therapies, and medical technologies, and bring those assets to patients. We are full life cycle and global in our philosophy. So we do everything from incubate assets out of academic hands, early stage, mid and later stage venture, as well as public market investing. We do have a London listed venture fund, which trades on the London Stock Exchange. And we're hoping to do more as we see a lot of opportunities and wonderful growth that's happening in the UK and in Europe especially. Personal background as well. I started out as an investment banker.
Chen.
Hi, my name is Chen Yu. I'm a managing partner, founder of a new firm called TCG Crossover. So we're a sister affiliate of the Column Group, a pretty well-known company formation VC. So our fund is focused 50% private, 50% public. So we really are smack in the middle of the crossover market. Before this, I was a managing partner at Vivo Capital for 17 years, which is another well-known life science investor that participated essentially across the board from early stage venture all the way through publics.
And Johnston.
I'm Johnston Irwin. I've been at Lilly for a little over 3.5 decades. So I am far older than I look or behave, as Regina likes to call it. I spent 14 years looking after our clinical development programs for our bone and breast cancer risk reduction portfolio. And then starting 7.5 years ago, we brought the majority of our venture capital investments in-house from 2 house funds that we had. People are probably familiar with Lilly Ventures or Lilly Asia Ventures. Today, Lilly has expanded that network into 16 families of funds, 21 limited partnerships. And then starting about 4 years ago, we started our own direct investment portfolio. And today we manage about 55 companies where we have direct investments. It's sort of an ever moving target. Frequently people ask if Lilly does this for the money or for the pipeline. And the answer to that, of course, is yes. But our focus is really on building assets of which Lilly would bring into our pipeline. And I'm proud to say in the 7 years that I've been looking after this, we've acquired outright 9 of the companies, and we have 23 partnerships with companies that are in the portfolio. So it's very important to us to leverage our 6,500 scientists into the companies that we work with.
Thank you. Now, Regina made an interesting point when she said this was not the year we thought it was going to be. I know what I thought coming into 2020 was we still had a pretty good IPO market, but it's, but bankers were telling companies, hey, if you don't have 75% inside participation locked up ahead of time, don't bother. So it looked like a boom, but it didn't feel like one because really people were buying their own IPOs. And so I was certainly bracing for a market that was slowing down and just seeing sort of alternative transactions. Then COVID hit, and then boom. I mean, I don't think I've ever seen it this hot. So what do you guys think caused it to take off so hot in 2020? Is it fundamentals, or is it generalist investors flocking to biotech? I mean, what do you think's driving this, and then where do you see it going? Wouter, do you want to start?
Yeah, thank you. So I think there definitely is an accelerated interest. I think one part is probably because the pharmaceutical sector is non-cyclical. So obviously in a volatile and uncertain market like this, that's attractive for a certain type of investors. I think secondly, the sector as a whole is probably also more under the intention of people. So with the whole pandemic, the importance and the relevance of healthcare is probably seen more. And I mean, you see it both on the public market side with the Nasdaq index being, Nasdaq Biotech Index being at all-time highs. But also on probably the private side and definitely the crossover side where maybe Chen can comment on more. But I mean, the amount of capital that's flowing into the market and not just with VC investors, but I think with all investors is probably at an all-time high right now.
Regina, what do you think caused it to not be what we thought it was going to be?
Yeah, I think Wouter is right. In the end, if anybody would have told us that within 10 months from actually starting to think about it, there would be a vaccine on the market that actually is supposed to actually now vaccinate a significant part of the world population, I think none of us would have actually believed that. I mean, we were ourselves in one of the vaccine companies that actually got acquired by MSD, by Merck. And I mean, the frenzy that happened around the deal making just in that particular little niche was just something that can only be explained by the fact that all of a sudden healthcare was actually showing what we can do. I mean, we knew that for the last kind of decades. We've all been in this for a while around the table, some maybe only 1 decade, some others like Johnston and me for a bit longer. But we have actually seen the power of what healthcare can do to change the universe. You mentioned the insulin, Johnston, going forward. And now all of a sudden we have the capacity of having something which is really life-threatening to humanity and actually do something about it. And in my view, that has really also changed a bit the sentiment of the generalist investors, that this is actually seeing that it was not only regulations and things becoming worse and markets becoming more difficult to address and reimbursement becoming tougher and real world evidence and all of those things that actually drug pricing, not to say, all of a sudden this was about us and this was actually hitting home. And in my view, this is not to be underestimated in a market sentiment. I mean, I'm not the banker here. I come from a scientific side. But I think that this is something showing the power of what our industry can do that I hope will also still be with us when the market has cooled down a little bit.
So, Bill, if I could just build on something that Regina made and to link with what you mentioned, at this very conference 1 year ago, I was on the podium saying the IPO market is shriveling and will evaporate in front of you. If you're a CEO, you need to be thinking of other fundraising tools, and there are many people in the room to be helping with that. And boy, one more example of how I can be wrong. But what I think has happened in the meantime is that our industry has gotten a flavor of the art of the possible. Everybody who comes into healthcare investing and healthcare creation realizes how hard it is and how challenging it is. And we know that the roadway is littered with many failures of companies that didn't perform, or side effect profiles, or off-target profiles that got out of control. But what we really learned was that, and I steal this shamelessly from another company, this is not a Johnston invention, that the science will win. It's a chance for us to show that the science can make a deliverable difference. And by working together and aligning to a problem, you see the things that Regina was mentioning. You see vaccine approval times in weeks, not in a PDUFA timeline of 6 months or a year. You see chances for countries to have overlapping opportunities. And then, frankly, one of the things that's happened is our timeline to getting at things, just like we're doing now on a video call, has fundamentally shifted. Instead of my flying to Europe for the day to meet with Regina or Wouter or otherwise about the newest science project, we can have a call in an hour and a half, and then I can matriculate that science into something else that same day. So it's hyper accelerated the pace at which we work at. I think the unfortunate thing to that is the white hot nature of what's occurred has put us in a position where companies that don't yet have animal data are in the $200 million valuation range. And I think we're going to see some kind of a reaction to that. I don't know what the reaction is going to be. I've already proved my inability to predict the future once at this very event. So maybe I'm hoping that the reaction is not some kind of pulling back from that, but rather embracing the science that's there for the companies that are successful.
I think one of the interesting things about the market today is that we've kind of been joking at our fund that data is your enemy right now. Narrative sells a lot better than reality. And that's a little bit of a scary place for investors when that happens. But it's very interesting. If you look at the amount of capital that's being raised in the biotech IPO market, right? I mean, I think it's like literally 3 times, the average median raise in IPO is 3 times that of pre-2015, right? So in this last era, it's just completely changed. In fact, the biotech IPO market is almost like a market into itself. I mean, it's created the whole crossover segment, which literally didn't even exist in 2013. So I think it's quite interesting to see what will last. I mean, at the end of the day, I think we had 13 billion of inflow into biotech in this last year. And my guess is, for the reasons that were mentioned earlier, I suspect a good chunk of that's going to stick around for this next cycle. So overall, I remain a bull on biotech.
Yes, please understand, I didn't mean to suggest that I was bearish in even the most remote sense. After spending my whole life here, I think our industry has an opportunity to offer things to humankind that are unparalleled.
I'm going to agree, with what was said, especially, Regina, I echo your sentiments entirely. We're a sector that the majority of the money that comes into this sector is actually not from specialists. So the last 5 years have seen this great big overhang, especially as we went into, the 2016 U.S. election cycle with drug pricing, at top of headlines every day. And then every year thereafter, there was a really big sort of setback. 2017 was a recovery year. So I think the generalists like to say, okay, it's back. But it was really only up like 20 some odd % off of a historic low. 2018, if you remember, fourth quarter, things sold off by another 30%. We had a recovery in 2019. So again, the generalists like, well, it's back, the index is at its high, but this was a lack of appreciation that the fundamental floor and the value of everything was rising because all of this great, production and new therapies were entering the marketplace. I would also add that, we can't emphasize enough how important being a full life cycle investor is. And I think, to Chen, like this whole crossover evolution that has taken place in the last, half a dozen years is so important because I think it distinguishes the investor that says to the company, look, we're not only going to, invest in you early while you're still private, but we're going to stay invested well into your public life cycle. We're not leaving you. We're not under kind of the traditional VC structure where we're sort of forced to distribute to our underlying investors at the time of the IPO, but we're going to stay with you. And I think that has really catalyzed a whole new style of investing. Plus, the science has been better, so it's enabled a lot of public market folks to go earlier and start supporting companies while they're private.
On that note, the crossovers, we seem to keep evolving. I think when the crossovers were starting, they were coming in right before you did your IPO. Sometimes the week before you hit the road. Maybe in a crazy case, six months before. It seems like crossovers are increasingly coming in Series A rounds. In some cases, incubating companies. In a lot of ways, acting like VCs. Which is a subtle but significant step. Do you guys? What are your thoughts on that? Do you see that happening? And are these crossover funds going to be? Are they going to be replacing VCs? Are they going to be working with VCs? How do you see that playing out? With the crossovers going earlier and earlier.
Yeah, no, maybe I can start. So we definitely see that happening in the VC space. And I think, Regina, because I think we're more in the same time frame of investing, I would say, but the funds that traditionally have been more public market orientated investors are also stepping in earlier into these crossover markets, and especially in the US, which makes the market currently like really red hot, I can say. We sometimes see deals where you can only do your due diligence in 2 or 3 weeks. And that makes it really difficult for a traditional VC investor because we cannot recycle the money. So after an IPO, we cannot quickly exit, do a quick flip and reinvest the money in a new momentum crossover deal, so to say. I think it accounts for all of us here on the call, but we invest because of the technology and we stay till the company, till the data readout is there. So I would say crossover deals that we only can do 2 or 3 weeks time due diligence on, we most often decline because that's also what you owe to your LP. So the type of opportunities we're currently invest in has really changed for VCs. The deals are more complex, like pharma spin-outs where you take the asset out, have to form a team or a company, or more complex structures in general, which are sometimes too difficult for pure crossover funds or even the public funds. Plus, we look at names a lot earlier, so a long time before the financing round, so we know whether we like it or not before the actual financing round is there. So maybe I will stop for here.
I may make one comment. I think, well, the reason partly why you're seeing is that effectively what happened is that because you couldn't essentially get IPO allocation. At the end of the day, crossover segment has been so profitable that it's an obvious thing to be investing in, right? So now it's an allocation question. And if you're a public investor without any company creation opportunity or a crossover opportunity, you basically couldn't get allocation. And so that forced you earlier. So now we're seeing that there's a pre-crossover round to the crossover round, which is almost becoming like you said, the Series A. So I think a little of that competition is a little bit market driven, and I think as the market cools, I think some of that will pull back. I suspect that a lot of the public funds that have created a lot of this company formation stuff, when reality hits and it reverts a little bit to the historical mean around what early stage investing is like, my guess is some of that appetite will cool. But I think the other byproduct is that if you look at where money is going, it's going into like 4 areas. It's not like everyone's raising all the money. If you're in specialty pharma, it's like good luck trying to get an investor. I looked at a crossover round about a week ago where there was a phase 3 ready asset, a phase 2 asset, no one's interested. And then in contrast, you saw a couple of IPOs that literally went with 0 data, essentially an idea on a napkin at a 650 million pre. So right now you're seeing this like massive ride of capital away from actual products toward, I think, big dreams. And so it'll be interesting to see when that rotation kind of goes back, what will happen.
Yeah,
go ahead.
I'm
sorry, go ahead. I was going to say, what are the 4 sectors? Well, Chen.
Yeah. So if you look at things, gene therapy, gene editing, orphan diseases, oncology, I think diagnostics took the lion's share of the capital. And then I think, of course, COVID related stuff, those 5 areas. But if you're in like derm, ophthalmology, GI, I mean, it's been actually quite tough. So it's definitely a kind of a winners and losers market, even within the broader overall biotech market.
I'm sorry, Regina, go ahead.
Absolutely. I mean, I can only say yes to what Jen and Walt have been saying. And maybe you said, when are we going to see things kind of cooling down or coming back to normal? My first boss in the VC industry used to say to me in the year 2000, remember one thing, it's the product, stupid. And the one deal we did in 2000 was GenMap, and we sold before data, because I mean, we couldn't reinvest, and we actually made quite a decent return before everything went sour and went down for a very, very, very long time. And I'll always remember that experience. And I think this is what we are going to revert to. We hear from people that do these crossover rounds, experienced investors that we rather saw as Series B investors used to do really proper due diligence, tell us, hey, we got this call, we basically just joined that syndicate. This is not going to be for us, because this is not what we as VCs in Europe do. So I think people that work with us will see same old. It will be science-based product development with people that we trust, that actually the underlying data is something that can be repeated, that if not, we will make sure that they repeat it as long as we actually believe it, and then taking people out. And I think in the end, this is what's going to make you money in no matter which market. And I fully agree with Jen. There's so many opportunities out there at the moment to buy at a reasonable price, that this is really something which I appreciate. So we actually feeling a little bit like kids in a candy store right now, because exactly as we said, everything that can't immediately go public and is in those sectors is something that's actually very, very interesting right now.
I'm going to just jump in and say one thing, that the crossover phenomenon does not necessarily, mean that, that investor is someone who's looking at an opportunity within weeks ahead of, the IPO, and then is just jumping on board sort of blindly because they're expecting to get, a 40% uptick. Certainly, from our perspective, so we have about 42 people, full-time employees at RTW. Half of us have terminal science degrees, and the other half have, banking or other transactional experiences that we bring to the table. But every investment that we make is really with, it's science driven, and it is how do we, appropriately assess the science and the value of this company. And then to the extent that we have other tools in our toolkit, to get them to where they need to be, then we do that. And so I think from our perspective, if we're leading a SPAC or we're syndicating a deal, it is absolutely with the intention of not leaving, at 6 months plus 1 day, we're not selling at that point. I mean, we are still, like every other investment that we make, intending to stick with that until we see that full value recognition, whenever that may be. So, so I think that maybe, all crossovers are not equal, but I do think it is, and I wish that maybe the European investors would appreciate a little bit more about the role that the crossover could play, between traditional VC and then the bigger, deeper pools of capital like the pension and the wealth managers later on, because it is a good validating point in a company's life.
And by the way, this was not that I meant that every fund at any time does that. It's only seen that I've seen people that usually would not at all consider themselves as crossover investors do those type of deals where they simply become part of a large syndicate that actually puts a deal together on a very, very short time note. So absolutely, I fully appreciate the value that RTV and also your colleagues bring. So if that came across that way, that was certainly not the intent.
So, Bill, sort of taking the summary from the thoughts here, one or two ideas to sort of mix with that is that I think that the lines between the types of investors are becoming more blurred. Part of this is because funds that traditionally had large capital draws, say $1 billion plus funds, now have parallel funds that are going along with them, the so-called opportunity funds or other investment tools So what happens is that, and then if you add to that exactly what Chen is mentioning from a very successful venture-based typical fund. So now you have a different pool of capital that many times has the same LPs or a lion's share that are the same LPs that are in a different vehicle for making those investments that you can carry on with the company for a longer time period. What was happening is that many funds were missing that next uptick in the valuation because they were running out of the potential to make the next investment. And so then as you build that, I want to reverse the equation from the discussion we're having from the investment side and talk about it a little bit in the free advice portion of the discussion. So worth what you paid for it. From the side of the person who's the CEO, the CBO, and the company that's raising the money. It would be our thinking that you should be very thoughtful about who you're bringing in and how long they're going to stay. So this builds a little bit, Stephanie, on your point of who's going to be with me for the long haul. Because the one thing, I'll go back to my predicting the future that I can promise you, and that is in healthcare, the road will get very tough. I assure you, after 30 years in the neuroscience business, we made a brilliant announcement for Alzheimer's disease a week and a half ago, and that was a 30-year project. It wasn't a 2-year project. And so when the road gets rough and you're looking around the boardroom as the CEO there, you want to be asking yourself, who's sitting here with me? And if it's people who are there truly for the long run, I think you're going to have a genuine opportunity to get the right kind of leverage to keep the project going and have it turn into something that's valuable for patients, caregivers, and the financial investors that were with them. If you've chosen to make a short-term win and you're hoping that while you're sitting on your yacht, you will look at having the kind of reflections back about where the company could have been, you're gonna find that you're gonna get left in the cold because they'll follow the money every day.
Reinforcing that, I mean, I've seen it a number of times where companies don't take the highest valuation that's offered to them. You'd much rather have the better anchor who will bring in better investors and set you up for a better future. The highest valuation today can actually cripple you tomorrow.
Exactly. Exactly. It's don't get ahead of yourself and realize there's going to be a nasty day. Chen, to your point on the data is your enemy, there's going to be a nasty day where one trial is a mess and one trial is successful. And you got to say, how am I lining this up? Or where am I going? Or why didn't we have this? And you need to look around the room and see where's the friendly face that's going to help you sort that out.
And one day you might not just have data, you might even have revenue, and then all mystery is killed. But anyway, one question from the crowd was, it was aimed at Stephanie, but it's everyone should take a shot. What kinds of investments are you looking for in Europe right now? Is there particular types of companies? Is it exactly what you're looking for in the US? I mean, what is the opportunity you see in the UK and Europe?
I guess I'll go first, but absolutely, everyone else chime in. I mean, I think, we think that there's been this incredible democratization of science and that, wonderful assets, because of this genomic revolution, we're able to see and get comfort around looking at data much earlier along in the process to actually sort of think that something is predictive of a successful outcome. And that we're seeing that happen, everywhere. At no-name institutions, we're seeing wonderful products come out, and the opportunity that we've, seen in Europe is, and in the UK, is that there's great programs that are coming out of UK institutions and out of European institutions, but what's lacking is that sort of venture and hedge fund, that capital markets ecosystem. So a lot of times those assets they find a home with a U.S. company or a U.S. backer. So it was one of the reasons that we really wanted to build a footprint in London so that we could be and kind of foster better relationships with peer investors like everyone here, and really kind of start to develop and maybe foster a similar type of community where where we can encourage great assets that come out of a UK institution to develop into a homegrown UK company.
Bill, I used to say I would follow to the ends of the earth to find great science and interact with true innovators. Now what I get to say is I'll have a Zoom call in the middle of the night with a great innovator from wherever that is. So it's certainly changed. It's changed that paradigm, the speed at which you can have an introductory call, and then I hope in the future an in-person visit to see the lab and interact with the staff and understand what's going on is wonderful, because you can't, we can't be everywhere at one time, but now with the technology of Zoom and otherwise, we're certainly reaching a stage where the speed at which one can work is moved at lightning pace as opposed to, the other days.
And I think with the crossover market being so active and on the radar with these big US specialist investors, it forces VCs to look at a slightly different type of opportunity. I would say generally a little bit more complex, as I said earlier. So I think if I talk about Forbion, we're pretty much agnostic to therapeutic areas. But the types of deals that we're seeing now that we actually have enough time to do our due diligence on are more like the pharma spin-outs, for example, where you take the asset out and form the team, or where a deal where you have a very concentrated shareholder base, for example, where it's difficult to raise. And also look earlier, and then I mean not specifically in terms of phase, because it can still be phase 2 or phase 3 assets, but more early in the process. So you really start landscaping the market to see what you find interesting companies before there's even a financing round going on or anything like that. Because in our experience, when the financing round is going on and you have these big US guys stepping in, you're basically too late. It's either issuing or co-issuing a term sheet yourself, or you're too late, basically, because stepping in at these late stage things is getting really competitive. So that's at least our experience here in Europe.
Yeah, although I have to say, the question is what do you look for in Europe? And in my view, you can still find in Europe assets that are actually not yet financed by international syndicates. But the great news is that in principle, now our companies can go towards the US markets after the Series Bs. So we have companies in our portfolio, like a company Imcheck, where we were actually struggling to get the Series B done in 2019 because it just closed December 2019. We invested in that round, and we got it done with the help of strategics. It was in this case Pfizer that came in, and now they're actually in the clinic, and now they're getting a lot of attention, and actually they're getting to a stage where it's clear that, I mean, if they continue to show in the clinic what they're showing, there's going to be public market interest. So in my view, investment in Europe, I agree with Johnston, it has become less important that things are in Europe. Now that actually also some companies from the Netherlands have shown that you actually can very successfully go public in the US. We have had some of our portfolio companies make there already earlier, like also the diagnostics at Oxford Immunotech that just has a nice exit by being taken over, but it becomes more mainstream. And so for me, honestly, it matters less, but it matters still with regards to getting into the deals, because there are still in Europe few people that really can do the groundwork. Because even if there are some people that basically say, well, I'm prepared to go Series A in Boston, it's different to do a Series A in Boston than to do a Series A in Munich or Eindhoven.
For European companies that are looking to access this capital, if they're not already backed by a sponsor who's connected into the network, I mean, how do you think the best way is for them to find this capital? Is it starting with trying to get on the attention of European VCs who are on the ground, or is it how they present their story in a way that it can be forwarded around? I mean, what, just
I think you need one anchor point. It doesn't matter what the anchor point is. You either need a board member that has the network, you need an investor that has the network. Ideally, you need all of that around. And so I think for European companies to immediately go and say, we go to the US, they can do that if they have the network already established. If not, and this is probably still a large number going via the European, the local VCs, because company building is still work. I mean, of course, if you have a very experienced team and it is in a super hot ecosystem, you can just say as an investor, here is my trusted team, here's your money, go do it the next time around. And we have also several serial entrepreneurs like Christian Schetter that helped us to sell Rigontic, is now a partner at RX, that helped us to form Stipe in Denmark with a very strong local team there. But actually then attracting people like Natalie Sachs to the border. So you need already that kind of network established, and that's much easier if you have a local reference point. So I'm just, of course, doing a bit of sales for us over here, but my feeling is that a good collaboration of local investors, no matter whether they are somewhere in the kind of other places than Boston in the US, whether they are in Europe or whether they are in Asia, with kind of the lots of money that then can really help to bring people to the attention of more generalist investors of NASDAQ, is the best combination.
No, I totally agree. I mean, I think that, we'd love to kind of help foster that investment, collaborative environment amongst investors who can support the companies that need local funding.
Bill, I would say that, sorry, Wouter. I would say that the hurdles of geographic diversity are lowering because of the electronic media that are available to have the discussions. But it does come back to the point that Regina made on two different, first was you need interpersonal assistance on the front of the fundraising. And the second thing is it still comes back to the management team. Who's the management team and how's the company going to be run? And that's sort of regardless of the geography. It's the experience base. It's how to network that. It's, another example is for clinical teams that were starting to try and get a clinical trial going during the COVID era. I mean, they were experiencing innumerable issues associated with that. So what kind of relationships do you have further downstream? How can you matriculate against that process? Still comes back to the people. It's a people business.
I fully agree. And what I wanted to add is, like, for a US investor to do a deal in Europe can be challenging, because Europe is not one big group, right? Doing a deal in Germany is totally different than in France or in the Nordics or in the UK. It's different regulation, different people, different cultures. And not many of the US funds have a local presence in the US. However, they are very good in finding late stage opportunities. I think about 2/3 of all the late stage deals in Europe is actually being done with money from US investors. And if I look at ourselves, like, all our companies that are IPOing are going to NASDAQ. There's not a single one that's currently listing in Europe, for example. And we are being approached very on a regular basis by this, like, the big US well-known specialist names. And we have, like, every, I would say, month or 2 months, we have sort of an update call. What kind of opportunities do we see in Europe? Is it something we can work on together? Because it's also interesting for us, if we bring a company to NASDAQ, like Stephanie emphasized, to have these US specialists on board that can bridge the gap to the US market. And I think that's also really important for the companies. But as Regina said, it all starts with the connection, whether it's the VC or whether it's a board member or the CEO or whatever. That's just how it works in the end.
Yeah. One question we got from the audience is a not surprising one, which is about SPACs. We're seeing a lot of companies do traditional IPOs, but we're also seeing an unprecedented flood of SPACs. What's your, I don't know, 10 years ago, 15 years ago, SPAC was a 4-letter word. They might say it's $100 million SPAC. They go out, they find a company, and then they get to the closing, and all the money that's in the trust goes away, and it turns out it's a $0 SPAC or a $5 million SPAC. So I think a lot of people got reluctant to do that. I think recently, particularly in healthcare, just like healthcare invented the crossover round, we're seeing a different kind of SPAC. We're seeing SPACs being put together by members of the investment community, bringing in their posse of other investors. And so they're actually bringing people that will stay in, they're looking for deals with a vehicle rather than just looking for deals. And so it's almost like you're just doing a crossover round. It's just you're going public at the same time. and those seem a lot more interesting. I mean, what's your perception on? And I know Stephanie, you have Spax. What's your perception on the biotech Spax? Who should be, who are the best candidates from them, and do you see them as being here to stay?
Well, Spax have, as you said, in the last year have really just, there's been a SPAC issuance craze. I think that the SPAC is a very valuable tool. It enables a company to go public a lot more quickly and without, as much of a burden on the management team to really, do your management roadshow and get that IPO shareholder syndicate together. That's sort of the duty of the sponsor of the SPAC. So you can really get a deal done in 3 to 6 months as opposed to the traditional path to IPO. It's certainly a great, I think, counter-cyclical tool for a company to go public quickly. I guess, we'll see. The jury's out on whether SPACs are here to stay. We think that they certainly are. There's a place in the market for them. I think that not all SPAC issuers are the same, and some will fail, and others we'll see. We'll separate the wheat from the chaff to see how what kind of deals get done over the next 2 years. And I guess that's the thing. But there's a lot of value for a SPAC to a company that is public ready and goes public in a very sort of quick and efficient way. In some ways, the SPAC is actually like a reverse merger, but without some of that red tape they have to deal with in a reverse.
We may have lost Bill from the.
I think we have, yeah.
I guess just continuing slightly on the theme, Stephanie, is it? Sort of my thinking is that all great ideas have their right time and their right place, as opposed to there's nothing new about SPACs per se. They were just called something different 30 years ago. And it's another financing tool that needs to fit in the right mix. And the place where people get into trouble is where they take the tool that is having some success and they apply it to their mix instead of thinking about what's the right tool for the right mix. And that's where I think you see these the SPAC situations that turned out to be not so pleasant of late. It's the ones that are based on, well, we don't really have great options, so therefore we're going to wedge this in and try and get this group of investors to come into it. And then 180 days expires and everything is not looking so pleasant. And what you find as the existing shareholders is, well, you just welcomed in a whole new group of shareholders, so now there are 3 people to sell instead of 2, and that turns into a whole downward cycle. So it just needs to be the right time and the right mix for what's happening.
No, exactly right. I think that if you're a company who is looking to go public and you're approached by a SPAC sponsor, I think you want to understand, is this sponsor doing the SPAC because it's part of their business, or is it just something that's very attractive and they think like, wow, we get the sponsor economics, which are a home run whether we do a good deal or not. So I think you need to sort of parse out whether this is a legitimate opportunity or not, and that's really kind of based on whether it fits in with the sponsor and what they do.
And I think you just need to also think about the complexities of seeing that through. Some European companies really see SPACs as kind of an easy way to an IPO. And we did one, and actually we did okay. And we still think the company is heavily undervalued. That's our company, Ematics, that went public via a SPAC during really the height of the first lockdown phase, was when the negotiations and everything was done. And this was the reason actually Ematics went for that option, was just because it was not clear how the markets would end up. And it was kind of felt because it was a good set of investors that it could actually turn out the right way. It has, but still in the end you have this hangover, and most of the specs, even the successful ones, they all seem to be ending up around $10 because there is people selling in there. And so I think it is kind of not an easy route. It is a route you have to plan super carefully, and I think if you do it with the right, not doing it with the right partners is in my view, not making it easier than a crossover on an IPO. And doing it with the right partners, you just have to make sure that really both sides get what they want, so that your story really has the right news flow for the public markets. Because otherwise, once you kind of de-spec'd, you're out there, and you better be prepared for what awaits you. And this is a lot of discussions that we're having with several of our portfolio companies these days.
No, that's absolutely right. And I think that one thing that, at least for us and in both of our SPAC issuances, is getting the right shareholder syndicate. So it is absolutely not helpful to the company or to, getting that long-term value recognition for the stock, because we want to stay with that long after the business combination if we have to turn the shareholder base in a massive way. So, we tried to cut out as many of the ARBs as possible and really focus on looking for fundamental investors.
And maybe a question, Stephanie, for the SPACs, because we don't have that many SPACs happening in Europe. Well, maybe one's raised, but not yet have an actual target acquired. So if you look at the real estate sector, you had these cash boxes for a long time. So it's groups that IPO, cash box, you have a very good experienced management team, and you acquire different assets. Do you think that we could see this happening in healthcare as well, that you have a thematic SPAC, for example, on a certain therapeutic area with a very experienced team of scientists that acquire different assets to build a pipeline in the therapeutic area, or is that a little bit too far maybe?
It's a good question. Actually, Bill and I chatted about this when we, ahead of this panel. Look, it certainly, you can do that. I'm not really sure why, though. It really goes back to saying that the SPAC is a tool and it's an alternative to the traditional IPO path. So it's really a way to find a company that you want to build and help them move forward and raise capital. And I think if you're going to start to think about the concept of, filling more of a fund structure with a number of different companies or assets, then, I think that's a different product altogether.
I think you could see it. There's risk. You need to do them all at the same time, at least for the first closing. And so there's always risk with SPACs of does something go wrong where it doesn't come together. So if you're putting together 2 or 3 companies, you got 2 or 3 chances for something to go wrong. I was really intrigued after I spoke to Stephanie about it, because I wouldn't be surprised with so many SPACs out there right now, if some of them that find it hard to find the really good IPO ready targets, that some of them don't look at putting together a few pieces together as a way to put together their deal. So I would personally be surprised if we start seeing those later, because watching it from the company side, there's the companies that could go IPO, could do a crossover, they could do a SPAC, and they're trying to weigh it out. Then there's the companies that are trying to figure out how to get into this, there's so many SPACs, but they're too small for all of them. At some point, isn't a SPAC that's having a hard time finding a target, and a couple of small companies in the same area that's having a hard time finding a SPAC getting together. So I think you could see it, particularly as people are going to have to get creative as the SPACs start to age and don't find a target. But I think it'll be really interesting.
I might suggest that you might see the application, Vulture, of your idea or concept, instead of therapeutically, you might see it platform-wise. You may see more applications in the gene therapy area, or you may see more applications that are based on a different platform as opposed to a therapeutic area. But I think you could see 3 or 4 of these coming together as companies sort of made simultaneous advancements. And that's where again, going back to my comment earlier on the being the right tool, then I think you have that. Then I think you want to have a public company with greater pace. It doesn't take away the risk, by the way, and my comments of earlier are still the same. When the road gets really hard, who runs from the problem? I assure you, it's not the people who joined you as the extra wheels on the SPAC. It's the ones who were there to start with.
That's right. Okay.
I like that. So we should definitely keep that in mind. So absolutely. And I think if we kind of keep that out of the pandemic, that it's a collaborative industry, and even if there's overheating in some sectors and such, that it's in the end about making a product that matters. And making money is important, but making a product is, I think, the prerequisite to doing so.
Okay. Well, I think this has been a great panel. I think we're at the end of our time. Josh, do you want to wrap it up?
Yes, fantastic. Thank you, Bill. Yeah, the time's kind of flown here with this conversation. As always, when you get together such a great active group of people with such knowledge, it seems to flow very quickly. Thank you all for your questions in the Q&A section on the right-hand side. If you do have any more, and obviously appreciative some people might watch this at a little later date, then please do keep the conversation going. Please keep asking questions in that Q&A function on the right-hand side, and we can get to them throughout the event. The presentation, or the panel, I should say, will be available on demand as soon as it's run, and indeed for the rest of the week, and indeed next week on the platform. A big thanks to Bill at Mintz and Johnston as well. Both Lilly and Mintz are long-term partners and supporters of LSX, and great insight on the panel, as well as to Stephanie and Regina and Chen and Wouter for their contributions today. That wraps us for the Biotech Leaders Agenda for today, but we're back tomorrow morning with our keynote panel at 10 o'clock. Tomorrow's day focuses on partnerships and deal making, and you'll hear from a number of pharma executives and large biotechs, including our Partnerships Against the Pandemic panel, which will hear from a number of the players developing vaccines and yeah, getting us through this tough time. Thank you all for joining. As I said, please do continue the conversation in the Q&A function, and indeed with our panel, and see you all again in the morning. Thank you.